Good afternoon, ladies and gentlemen. My name is Ed Murphy from GreenTechHQ, an innovation hub to help companies in the southeast of Ireland. We help them with every element of their business to try and help them grow and develop in these economic times. One of our fantastic sponsors here in GreenTechHQ Innovation Hub is AIB Bank, for which we're extremely grateful. Today, I've got John Fahey. John is the senior economist with AIB Bank, and John is going to talk to us about these, let's call it, economic uncertain times. But just before I start, just to let you know, you have a Q&A in the slide. So if you have any questions, please put in the questions there, and we'll make sure that John gets a chance to answer those questions at the end of the talk, and maybe even a few of them during the talk. So you're muted at this stage for microphone and camera. Stay unmuted if you don't mind, and ask any questions in the Q&A section. With that, I'd like to hand over to John and let him go through what he believes we should look at it from an economic update, and how we should look at doing business coming from the Irish economy. So welcome, John, and off you go.
Okay, thanks, Ed, and thanks for the invite, and good afternoon, everyone. So as Ed was saying there, I'm going to give a macroeconomic update in terms of where we are at the moment. I think Ed mentioned the word uncertainty, and that's very much the buzzword at the moment in terms of as we look at the economic outlook. But just to put kind of some structure around what I'm going to talk about today, I'm going to set the scene first globally in terms of the global macro backdrop, and obviously the obvious discussions there around trade and tariffs and uncertainty and trade agreements, and where we are from there on out. And then from that, it will flow into just the interest rate outlook in terms of where we see ECB official interest rates going. And also within that context of financial markets, what's happening in currency markets. And that will very much then set the scene for the Irish economy, because as a small open economy, anything that happens in the Irish economy is very much contextualized in terms of what's happening globally. And I'll finish up then with some of the risks to the outlook, but also, the challenges and the opportunities that exist there, given where we're currently situated. So in terms of just the global macro backdrop, on the first kind of visual slide there, you'll see this is just the general economic policy uncertainty index. And you can see there that no surprise, in the very early part of this year, it was at all-time highs, both around US economic policy and general global policy. And we can see since then it's come back a little bit. And the reason for that is that we've seen progress in terms of trade agreements. Now, agreement, I suppose, needs to be taken carefully, because none of these are actual trade deals yet. The terms and conditions, they're very much political agreements at the moment. As we know, in relation to Brexit, it takes a number of years to negotiate trade deals. So they're very much politically agreed trade type arrangements at the moment, but the T's and C's will only really get developed over the next year or so. And uncertainty is important because businesses tend to hold off making decisions, investment decisions, against a heightened period of uncertainty. So any sort of periods of uncertainty do weigh on growth from that perspective, because businesses hold off making on major investment decisions. And at the same time, consumers too hold off on certain types of purchase. So uncertainty weighs on activity from that viewpoint. But as you can see there, we have seen some level of reduction in that uncertainty, given we've seen at a very high level progress on political agreements in relation to different trading arrangements with the US going forward. So then on the next slide, what we just look at here is how the data is performing versus expectations. So this is actually tracked by different indices, and the way that you look at this is that if the line is above zero, it means the data is tending to surprise to the upside rather than to the downside of expectations. So you can see there for the US economy this year, in the last while, data has tended to surprise back to the upside, but for much of the year, that line was below zero. In other words, data was disappointing versus expectations. It was a similar picture from a UK perspective. The early part of the year, disappointment data, then it started to beat expectations, and more recently it's been a bit more negative. From a Eurozone viewpoint, data has tended over the year to come in better than expected, and similarly in terms of emerging markets. So it's been a mixed picture over the course of the year in terms of data and how it's printing versus expectations. And then if we look then on the next slide, just in terms of growth expectations themselves, so what we pay close attention to are two key global independent international forecasting organizations, the OECD and the IMF. And of those two, the IMF has been the most recent in terms of its economic update. And you can see there in terms of growth expectations for the global economy, the very top line there, global growth this year expected to be in around 3%. So the IMF in its latest update is expecting much slower growth compared to what we saw last year. And in a historical context, growth close to 3% is below historic growth for the global economy. It has tended to be much closer to 4%. So this is important when you talk about the Irish economic outlook, that the global backdrop is one of relatively subdued growth in historic terms. And if you look at the key global economies, and from an Irish economy perspective, obviously our main trading partner is the Eurozone, followed by the UK and the US. And in terms of the global economy, obviously the US economy is the world's largest economy. And what we've seen this year as the year has progressed and against all that policy uncertainty in the US, is analysts and forecasters have downgraded their expectations for US growth. And it's likely this year it could be below 2 or close to 2%, as opposed to growth much closer to 3% over the last couple of years. But if you look at what's expected from the Eurozone, even though US growth has been downgraded in expectations, it's still likely to outperform the Eurozone and the UK, because for the last number of years, growth in the Eurozone and the UK has been very muted, and it's struggled to get above 1%. Now, the difference is that the trajectory of the US economy is slowing, whereas we're seeing a modest pickup in the trajectory of both the Eurozone and the UK economies. But in absolute terms, when you look at their growth rates compared to the US, you're still likely to see stronger growth in the US over the next 2 years, but it is a slower growth trajectory, whereas a modest pickup in Eurozone and UK growth is expected. And the IMF now would have produced these forecasts just before a lot of those trade progress was made, but they did highlight that highly unpredictable economic environment, and downside risks have intensified. And even though there are some political agreements in relation to trade and tariffs, there still is some level of uncertainty over whether those agreements will actually materialize into concrete trade deals and what the end outcome will be of that. So it's very much in the last 4 to 6 months, a big change in positions from a trade perspective, and that's driven sentiment and negativity and uncertainty from that side. And on the next slide, we can just see the impact that's had in terms of expectations. So the IMF at the start of the year, what they expected for global growth is the darker line there, and the lighter pinker box is growth expectations as of July. So you can see for 25 and 26, they've downgraded their growth forecasts. Similarly, if you look at the UK downgrades, but where it's been most stark has been for the US economy. So at the start of the year, before all this trade uncertainty, they thought growth was be closer to 3%. For this year now, they expect as of their latest forecast, growth closer to 2%. So nearly a 1% downward revision to growth forecast. From a Eurozone perspective, there has been a huge change in growth expectations there. So even though the uncertainty over trade has been a negative, what we have seen, and this is one positive from all the uncertainty, is that because the new US administration under President Trump has told Europe that it's going to pull back on the level of defense spending the US will provide into Europe, European governments have had to step up to the mark. And at the same time, we've seen the German economy and the German government make a major decision around loosening its debt brake and allowing more fiscal expansionary policy. So that's a positive for Europe. We've been looking for the German economy and German government fiscal policy to become more expansionary over the last number of years. So because of the change in US administration policy towards Europe, it's forced EU and some EU governments to ramp up their spending. So that's actually a positive from a Eurozone economic outlook. And it's a positive for the Irish economy then, because the Eurozone is our largest trading partners. So that's the general growth backdrop. Just on the next slide then, just want to talk very briefly around energy prices, because for the last number of years, businesses have been dealing with a lot of fluctuations in energy and cost of energy in the aftermath of the Russian invasion of Ukraine. And where we saw that impact most was obviously on gas prices. Since then, gas prices have settled down, and they're actually below the levels of where they were at before the Russian invasion of Ukraine. What we're seeing still from an oil price perspective is volatility, and oil prices are probably the most volatile to geopolitical developments. So anytime there's any sort of a flare up in geopolitical risks or developments or news flow, it does tend to get reflected in some volatility on oil prices. But again, though, even though it's been more volatile than gas prices more recently, it's still well below its 2022 peak. So even though we're seeing volatility there, I suppose the key message from an energy markets and commodity markets perspective around energy costs is that, you know, they've settled down a lot, and wholesale prices in terms of in markets itself are at much lower levels than where they were 3 to 4 years ago. And you see the impact that then has had on inflation. So on the next slide there, all I've done here is I've looked at the key inflation rates for the US, the Eurozone, and the UK. And when you're looking at inflation, there's the headline metric, which is the red line, and that includes energy and food prices. And then your blue dotted line is your core inflation, which strips out energy and food prices. And that's important because the headline rate can be much more volatile and driven by energy prices. And you can see that there, if you recall back to the previous graph, you saw the huge sharp increase in gas prices and then the fairly significant sharp fall back in it. And basically your headline inflation rate followed a very similar trajectory. But core inflation was slower to move higher. And core inflation is important because that's what all the main central banks look at from a monetary policy perspective. That blue dotted line that strips out those volatile energy and food prices. But they central banks want that blue dot line is to be in around 2% on a medium-term basis. So even though the peak in core inflation wasn't as high as headline inflation, it's been much slower to come back down. And in economic terms, we use a very fancy term called sticky inflation when we talk about core inflation. So you can see, generally speaking, though, it has been on a downward trajectory. I suppose a key question in terms of the outlook now is the looming impact from those increased tariffs. And the general view from central banks, even though there's a lot of uncertainty, is that it may cause a one-off hit to inflation in prices, but that they don't expect it to have a long-term impact from an inflationary viewpoint from that side. And the other key thing to look at, because this forms a key part of what central banks deliberate when they talk about their monetary policy settings, is the unemployment rates. And on the next chart, next slide there, you can see the three equivalent unemployment rates for all those economies. Now, you can see the spike higher that happened during COVID, the pandemic and lockdowns. But since then, for all those economies, unemployment rates were either at all-time lows or close to 40-year lows. Now, we have started to see them tick a little bit higher over the last while. So there is some spare capacity coming in labour markets. And central banks pay close attention to both the inflation backdrop, but also labour markets, because their key concern is that if there's a lot of price pressures in the economy and labour markets are tight, in other words, employment's strong, the unemployment rate's very low, their concern is that you get a wage cost spiral in economies, which keeps inflation persistently high. So in terms of monetary policy and where it's come from, you know, the expectation was that over the last number of years, we have seen central banks, first off, increase in interest rates, get inflation back down. So we have started to see some softening in labour markets, and the unemployment rates have started to tick back a little bit higher. So that sets the scene then in terms of the interest rate backdrop. And on the next slide there, as we move through the next one after that. Thanks, Jonathan. So this is where the ECB Eurozone interest rates. So these are the key official rates, obviously, from an Irish economic perspective. So you can see there in terms of, you know, we went from a situation in the Eurozone where the deposit rate was at minus 0.5 up to a high of 4%. And in the last 12 months, since July 2024, what we've seen is that the European Central Bank has become more confident that that blue dotted line in terms of core inflation has been easing back closer to 2%. So they've been on a very definitive but gradual pace of reducing rate where they were. So, what we saw last year was 100 basis points of cuts, and what we've seen year to date is 100 basis points of cuts. So the deposit rate has gone from 4% down to 2%. And the blue dotted line on the graph there, what this is actually market expectations. So markets actually trade expectations around where official rates are going to go. So it's what's known as futures contracts. And there's a contract for each month. So you bring all the months together and you can see where the market thinks official rates are going to go. Now, just because the market's pricing it in doesn't necessarily mean it's going to happen. But what I've done there is I've just looked at market expectations at the start of the year, which is the light grey dotted line versus market expectations as of last Friday. So you can see the market's not ruling out rates getting to 1.75%. It's not fully expecting it. But as we move into 2027, the market is expecting that the ECB will start to increase interest rates back up gradually. And as we moved out towards 2029, the market's expecting that we could get back towards 2.25% to 2.5%.
John, can I jump in there for a second? What might it take for interest rates, EU interest rates, to go back even further at this stage? What would it take for the ECB to decide to drop interest rates further, or is that a possibility?
Yeah, so it's a possibility, all right, and the market's not ruling out. If you see there on the graph, they're getting down towards 1.75. It's not fully expected, but it's not ruled out. So if there was a further slowdown in the Eurozone economy, and the ECB was of the view that the Eurozone needed lower interest rates, needed further stimulus to boost growth. So if it started to see a situation where its expectations for growth were not being met, and growth was going to come weaker than expected, and there was a risk that inflation could undershoot its 2% target, then the ECB could start to cut rates further. And the ECB still has a willingness to cut rates. It hasn't ruled out itself cutting interest rates. Our own view would be that we think 2% where they are at the moment is the low point, but it wouldn't take a huge amount for them to move it down to 1.75%. If they were a bit more concerned about the economic outlook and thought growth was slower, that they needed further stimulus, then that would be the key driver as to why they might cut rates. But I think key takeaway is that any further rate cuts from here on out, even on a weaker growth trajectory, are likely to be fairly limited. So, at different stages this year, at the height of all that uncertainty, the market wasn't ruling out rates getting back to 1.5%. But, you're not getting back to the level of where we were previously for many years, where, the deposit rate was at zero. I think if there was further shocks, maybe another 25 to 50 basis points from the ECB. But where we stand at the moment, and in terms of our outlook, we think we're at the low point of rates now, 2%. And we think that they'll probably remain at 2% through the end of this year and into the end of next year. And then maybe as we move to 2027, we start to see very gradual pace of rate hikes. And if that materialized, that would be a positive from the perspective of it means that the ECB is confident that the Eurozone economy is picked up and that inflation is relatively stable. From that perspective. So that's the interest rate backdrop. So just very briefly then in terms of where we are for currency markets. And one of the interesting things we've seen in the last couple of months has been that the dollar has been on a very weakening trend on markets. Now, it started the year from a position of strength. Euro dollar, which is the most traded currency pair out there in the markets, was down below the 103 level. But really, the market started to get more concerned as we moved through the year about the US economic outlook and the US fiscal position and the debt sustainability of the US economy. So we've seen a fairly sharp move around 14% in terms of dollar weakness. And in other words, the way of looking at it is euro gaining against the dollar. So, at the early part of July, in fact, it was the 1st of July, we saw euro dollar get back up towards that 118 level. And for the last while, we've been generally trading in a 116 to 117. And if you think we started the year down around the 101 to 102 level, so the euro has been much stronger. Now, that in itself causes issues for Irish exporters into the US. Because of such a move from a dollar perspective.
John, what would be the outlook for the dollar, because of this uncertainty on an ongoing basis?
Yeah, well, we've had a view for a while in the AIB Treasury unit that we felt that the dollar was probably on a weakening trajectory. What caught us by surprise this year, though, was that the speed of that weakness. So the key level to look out for in euro dollar is the 120 level. Really, since 2014, the currency has not traded above 120 on a sustained basis. So we've got as the high we've reached so far, as I say, there is 118.3. So we haven't even broken through 119. So, economic uncertainty in relation to the US economy will probably keep us above the 115 level, may push us close to 119. But really, to sustain a break above 120, you probably need positive news flow in relation to the euro. So the reason for the move in the euro dollar rate there for much of the year has been dollar weakness rather than euro strength. So to really push us above that 120 level, we probably need to start to see the eurozone economy start to surpass growth expectations. So our view would be that we see further weakness in the dollar, but from the current levels, it may not be that far away. So in other words, we've been close to 117, 118. We think we can push up towards 119 into the end of the year, but our view would be that 120 is probably a stretch too far to break above it without some strength or some driver on the euro part rather than just specific weakness. From a dollar perspective. And then just very briefly on euro sterling, what we've seen over the last while is sterling has tended to weaken against the euro on a year-to-date basis, but it's much more narrow, the trading range, compared to the big swings we've seen in euro dollar. And we think 86 to 87p is a reasonable expectation for euro sterling between now and the end of the year. So that sets the scene in terms of where we are from a global macro and markets perspective. So if we bring it closer to home now, in terms of the Irish economy and the operating environment for many of the businesses on the call this morning, and we always emphasize when we talk about the Irish economy, the need to ignore GDP, because we're all probably well aware at this stage of just how much GDP is distorted by multinational activity. Excuse me. So we focus on domestic demand, which is the bottom modified final. That strips out that distortions caused by multinational activity and aircraft leasing activity. And when you can see there, obviously COVID distorted the growth rates in the economy. We've got a sudden contraction and a sudden expansion. But if you look over the last while, from a domestic demand perspective, the economy has grown from growing closer to 4% probably to sub 3%. And that's reflected too if you look at consumer spending, which is a relatively clean measure as well of underlying economic growth. We've gone from 4 to 5% to growth in and around 3%. So that suggests that the economy is on a slightly slower growth trajectory. And if we look at the next slide too, to some other key indicators from that perspective, employment. And if you look at the key employers in the economies are not the multinationals, the SMEs. At least at a conservative estimate, 2/3 of all employment is generated by SMEs. And just last week, actually, we had the latest employment figures, and they come out on a quarterly basis. And they show that in Q2, employment growth was still very strong, just above 2%, but it was slower than what we saw in the first quarter, which was closer to 3%. So we are starting to see some cooling in the rate of jobs growth in the labour market, which is no surprise because there was no way the economy could maintain that strong level of jobs growth, which was much closer to 4%. And we have started to see a slight tick up in the unemployment rate too. It's gone from been below 4% to been above 5%. But for all intents and purposes, though, the economy is still at full employment levels. Another key thing we always pay close attention to is our inflation rates compared to elsewhere, because this is a measure of our competitiveness, and as a small open economy, remaining competitive is key. And you can see the green line there for Ireland follows a similar trajectory to UK and Eurozone inflation. Actually, at the moment, the inflation rates in Ireland are slightly below some of our key export markets. So that's a positive. And then another important metric that we look at are what are high frequency indicators. And AIB actually sponsors these monthly surveys of, they're called PMIs, Purchasing Manager Indices. So they're for the manufacturing and services sectors. And the way they work is that if it's above 50, it signifies the sector is in expansion. So you can see there that the manufacturing sector has been, flirting at different stages over the last 2 to 3 years with contraction, because global manufacturing has been that way. But the services sector has remained strong. But what we are seeing over the last while, though, there, if you look at the light pink line, is that it is moving back close to 50. So the services sector is still growing, but the rate of growth is on a slightly slower trajectory now. So, that's just another indication in terms of that, the economy is still growing, but it does look like it's on a slower growth trajectory now. And then just very briefly on the next slide, in terms of the housing market. Now, we could spend all day talking about the housing market, but everyone's well aware at this stage of the issues in terms of where we are. It's very much a supply issue versus strong underlying demographic demand. So you can see there in year terms in the chart, house price inflation is still running close to 8%. And that's against the backdrop of 9% growth overall in 2024. And in the last 2 years, we've seen a re-acceleration in house price growth. And that is starting to impact affordability. You can see, housing repayment affordability has moved substantially higher over the last couple of years against that backdrop of higher prices. Now, I mentioned there the key thing is supply. And on the next slide there, you can see in stark terms just that supply picture. So CSO housing completions, they're basically new supply on the market. And, at a minimum, the Irish economy needs close to 30 to 35,000 units per annum just to meet annual demand. So you can see in 2023, we got close to that. But then last year, obviously, we've seen that well-publicized fallback in supply. And really for 2025, for this year, we may get back only towards the levels where we were in 23. And, running to a standstill, you need to meet 35,000 units first per annum to meet annual demand. But then over time, you need to build more than that to meet all that pent-up demand. And the central bank has estimated that in the region of 52,000 units need to be built per annum out to 2050 to meet both annual and demographic demand. And we saw, commencements get boosted last year in 2024, but a lot of that was distorted by waiver and rebate deadlines. So there still is uncertainty in terms of how a lot of those units that were started back then, the time flow before they come in. So against that backdrop of still supply not meeting demand, we would expect to see continued upward pressure on prices. But as more supply comes on stream, you would expect more lower single-digit growth rather than higher single-digit growth from a housing supply perspective. And then just in terms of the next chart, and this is a really key differentiator from where we were back in the aftermath of the Great Recession, that the debt dynamics of the economy are in a much more favourable position now. The household savings rate has normalised after the pandemic boost to it, but the levels of savings is still very strong. Household debt to disposable income is reflective of households having much healthier balance sheets, similarly in terms of private sector balance sheets, and also from a national debt perspective. So, even though we're dealing into a period of, ongoing uncertainty, in terms of the economy's debt dynamics, they're in a much more favourable position of where they were previously. And then in terms of just some of the key themes, just to finish up, and the outlook. So just moving on to the next slide there. And after that, obviously, the big uncertainty at the moment is trade. Okay, so we know that at a broad political agreement level, we have 15% tariff agreed between the US and the EU. And when we look at the US from a goods export perspective, the US takes roughly 32% of our exports. But of these exports to the US, pharma accounts for 18%. Now, we saw last week that the announcement that 15% tariff would also apply to the pharma sector. So that brings some certainty around the tariff. But pharma industry is still in focus for the Trump administration. The US administration is still undergoing some analysis in terms of the pharma industry. So I think there still is a bit of uncertainty there. And you could have the hit from an impact on tariffs, but also changes to the US corporate tax code, which could impact the pharmaceutical sector. And because when the US looks at Ireland, it sees that nearly a fifth of all its imports for pharma come from the Irish economy. So that's strange from a US economic perspective when it looks outwards and sees a small economy like Ireland being such a key part of its pharmaceutical imports. Now, just on the next slide, just to contextualize multinationals. So multinationals drive our GDP number. You can see there in terms of turnover and gross value added. But as a source of employment, they're much smaller. I think I mentioned earlier, SMEs are the key employers for the Irish economy. So that in terms of direct employment, it's in around 10 to 12%. But where multinational activity is key in terms of overall turnover for the economy, and also the stock of FDI is obviously heavily concentrated in US multinational activity. So that's the key driver but from a labour market perspective, it's much more centred around SMEs. And then just to finish up in terms of the risks, challenges and opportunities, I talked there around that subdued global growth backdrop. A small open economy like Ireland, global economy, how that performs will determine on a long-term basis how the Irish economy grows. We've had the Fiscal Council warning on previous budgets in terms of the expansionary nature of that. And one of the things that gets called out is the FDI concentration. 3 companies at the moment roughly account for over 40% of all our corporate tax take. So that's a key reliance there, but also just the energy import reliance. 85% of all our energy is imported. So any sort of shocks to international energy markets have a direct impact. But really, the biggest constraint domestically is around capacity, not just in relation to housing, labour, but electricity and other infrastructure around water. Now, there's positive developments in relation to the National Development Plan and the significant infrastructure spending on that, but that's going to take some time to feed through. That all leads into competitive issues. We need more infrastructure. We need to increase the supply capacity of the economy to make sure we remain competitive. At the same time, too, the economy and the population, we are a slightly aging population compared to where we've been previously. So that brings different strains. It also brings different opportunities from an economic perspective. And similarly, too, as we transform to a more sustainable, ESG-friendly economy, the opportunities that will develop and the challenges that arise from that. And at the same time, too, in terms of, AI developments, really in the last 12 to 18 months, we're starting to see more day-to-day impact in relation to AI. So just to finish up then, in terms of where we are on the outlook, we're generally cautiously optimistic from where as we look ahead. The labour market remains strong. Fiscal policy remains supportive of growth. The economy is carrying much lower levels of debt compared to where we've been previously. If you look there at the chart on the right, you can see, as opposed to a lot of other economies, the level of deposits that were built up during COVID are still largely haven't been run down yet. So that's a positive from a domestic economy perspective. And when you look at the consensus for forecasts, underlying growth, the general view is growth can be achieved within around 2 to 2.5%. Over the next 2 to 3 years. So, we're moving from a situation of growth of above 4% to below 3%. But you compare that to a lot of advanced economies, it's still a very healthy growth rate in comparison to that. So I'm going to finish up there and hand back to you, Ed.
Okay, John, just to finish with a question, any questions? One is, if you were advising the Irish government as to what to do in the budget to deal with the challenges for the Irish economy and for businesses generally who are trading, what advice would you give them?
So I think from an overall macroeconomic perspective, I think it's around, the capacity constraints in the economy, because, businesses talk and are suffering from, a high cost of business. And a lot of that is because of the capacity constraints. So from a budgetary policy perspective, I think key focus should be on capital expenditure and increasing, the supply capacity in the economy, reducing some of those bottlenecks, which in turn then will help to reduce the cost of doing business over the medium to longer term. And that's how the economy will be able to achieve more sustainable growth. So I think it's to focus on those capital projects whilst they take time to come to fruition, what's been outlined in the National Development Plan, and then just to enact the policies to achieve some of those. So to very much focus on capital spending and improve the growth potential of the economy, I think should be a key focus.
Okay, another question I have here from one of the attendees. Ireland relies heavily on a small number of big multinationals for corporation tax. And at the same time, we're facing real capacity pressures in terms of housing, energy, and infrastructure. If global growth slows or investment shifts, how exposed are we? And what do you think Ireland should be prioritising in the next few years to stay competitive and build more resilience?
So I think one aspect of that is we've seen the government is aware of that. So that corporate tax thing is a valid point. I think that one of the bullets I had there was 3 companies account for 43% of all our corporate tax take. So the government over the last number of years has set up 2 separate sovereign wealth funds. Because the Department of Finance themselves have done some analysis and they've estimated anywhere between 10 to 14 billion of the corporate tax take will be one-off in nature. So that initiative they've introduced of setting aside some of that one-off element of corporate tax to meet different challenges that the economy faces over the next while. So I think that's a positive. So it's important to keep putting money into those 2 sovereign funds because some of those are geared towards making the economy more sustainable, but also to deal with some of the challenges around the age and demographics in the economy. And then aside from that, I suppose it's back to the point I said originally, FDI are a key driver of our exports, and they're a key part also in terms of R&D, research and development. But it's to continue to develop our SME and our entrepreneurial in terms of the Irish economy and start to see, Irish multinationals. So we have a number of examples of those at the moment, but it's to increase, incentivize and help those type of companies grow so that we're not just reliant on foreign direct investment, that we have some major multinationals itself develop in the Irish economy. And this is something that Europe overall is looking at in terms of European companies versus US companies. In the last 10 to 15 years, all the largest companies that have developed have been US companies. So it's a challenge for not just Ireland, but for the Eurozone in terms of being able to embed and reduce regulation at EU level to incentivize more companies domestically to be able to grow on that basis.
Okay, very interesting. I have a question here from Charlie Swords. What trends are you seeing in corporates and SMEs read their investment in their growth? Is there any specific sectors that are more impacted with the current uncertainties?
Well, what we've seen generally is that the manufacturing sector has been more challenged over the last number of years. So in terms of what we're seeing trends, I mentioned there that the survey there, the manufacturing PMIs have seen a more challenging backdrop, all right, compared to the services sector, because the global backdrop has been of slower growth. So service sector firms have tended to perform better in some instances because they're more domestically focused. And obviously we've had stronger domestic growth. But I think that if we get more certainty around these trade arrangements and the T's and C's start to get put into operation, then that should help the manufacturing and because manufacturing tends to be more export orientated. So as we move ahead to next year, you could start to see improvement within the manufacturing sector. At the moment, survey data suggests it's underperforming the services sector, but as we move ahead into next year, more certainty over those new trading arrangements should be support to manufacturing and manufacturers that export.
Okay, fantastic. Just last question here, John, and as SMEs face growing pressure to invest in sustainability, from energy efficiency to reporting requirements like CSRD, how do you see these changes impacting their competitiveness and costs in the short term? And are there economic opportunities you think SMEs could capture from the transition?
Yeah, well, I think in terms of obviously the initial adjustment to additional reporting requirements, obviously in the near term, is a headwind as companies adjust to those new reporting requirements. So in the short term, it's obviously an additional challenge. But I think I mentioned there, one thing the Eurozone and the EU, generally speaking, has become more aware of is its competitiveness issues compared to the US. So the Eurozone actually, the European Commission actually got Mario Draghi to produce a report around competitiveness in the Eurozone. And it's looking now seriously at trying to reduce some of that regulation because there's a famous saying, US innovates, China replicates, and the EU regulates. So there is a concerted effort at your EU level to try and look to reduce the level of regulation and red tape that businesses generally face. So it's to see how they can be streamlined to make sure they can still meet those ESG criteria, but to make it more streamlined over time. So that would be a positive. And I think as we move towards that more sustainable economy, obviously some sectors may become more obsolete, but new sectors will develop in that ESG environment. So I can't pinpoint anyone exactly at the moment. If I could, I suppose everyone would be invested in it. But I do think that there are new opportunities that will develop, and I suppose Ed, you might have your own view in terms of where that could be, given your background and what you're seeing with talking to customers and that.
Yeah, okay. Look at John, thank you very much. That was really, really helpful, and certainly very helpful, certainly to me and probably a lot of other people, in terms of understanding some of the uncertainties and understand some of the fundamentals as well that are still in place and will continue to be in place. And people need to look at the idea of continue to innovate rather than kind of sit tight and not make decisions. But so thank you very, very much. Thank you all for joining us online today. It's been fantastic, and we hope to come up with a number of these webinars that should be helpful. But for the moment, thank you very much, very, very much, John. That was really, really, really helpful. Thank you. And thank you all for joining us, and hope we'll see you all soon. Thank you.